The wrong one here. Here we go. Okay, Foreign Corrupt Practices Act. This made it Foreign Corrupt Practices Act made it illegal for U.S. companies to bribe foreign governmental officials. That was a problem that they had, was that the U.S. companies, when they wanted to do business in some country, they would go over and bribe the officials, get the contracts, these lucrative contracts, a lot of times for countries that were not very large, and that they would basically be ripping off the countries by paying some bribes to people. $1 million would go a really long way in bribing somebody in some of these countries if they could insert the U.S. companies there. And the U.S. government didn't think that was very funny, so they made a lot of the Foreign Corrupt Practices Act. And the Foreign Corrupt Practices Act did a number of things, but it made it so that companies and the individuals in the companies are on the hook for these kinds of activities. So bribing the foreign officials is illegal. And one of the interesting things about it was, there's a couple things in the act, but the first one is that all transactions but that's knowledge. Doesn't look like knowledge, but it is. All transactions are complete with government knowledge. Now, that might sound, there's a couple other things, there's a few other things in the act. Regarding that they have to keep track of assets and all this other stuff. But the reason why that is such an important aspect of it, that by law, all transactions are completed with management's knowledge and approval. These different companies, they'd all have people that stand up in front of Congress and say, well, I didn't know that was going on. If I had known it was going on, I would have stopped it. Once this law was passed, under the law, you did know about it. You cannot use the I didn't know excuse. So anyone in upper management knew about it, and they could not use that they didn't know that it was going on. Oh, we didn't know that was going on in that country, and we didn't know anything about it. You can't do that anymore. Now, the interesting thing about that is it was the first law that made companies responsible for their internal control. Up until that time, you didn't have to have internal controls. You could run a company however you wanted to run a company. But this law said, okay, you have to have internal control so that you know what's going on with the company, and that all these transactions are done with your knowledge. So you have to have control set up so that, if you want to know those things that are going on, to evaluate that. So it was a very important act, and it still comes up some today. The last company I think that I saw get hit with it a few times is Walmart. I think in some countries they are kind of, they're bribing officials to get stores opened up. But and those bribes by law, Walmart upper management knew about, if they're proven. I don't know how those all those all panned out legally. Okay. Sarbanes-Oxley Act. This comes on because of some major frauds they had with different companies, and they were large fraud. WorldCom was the one that one of the big ones. Enron and WorldCom were the two big ones. And these were billion-dollar frauds. The Sarbanes-Oxley Act is actually fairly interesting. It was around for years. It was literally around for years before it was ever made into a law. And that corporations always killed it. They always had enough people in Congress that they could get this the Sarbanes-Oxley Act killed. But what happened after Enron was the big one. It was a billion-dollar fraud. It was a huge thing all over the news. Blah blah blah. Killed the CPA firm of Arthur Andersen, which was the largest U.S. CPA firm, and big news. And as the dust was kind of settling from that, and by the way, there's a billion-dollar fraud. We used to talk about big frauds as being $50 million. This was way more. So once the dust started settling, then about a year later, the WorldCom one hit, and the WorldCom was even bigger than Enron. It was the $2 billion fraud for WorldCom, and immediately all of the stocks started tanking because no one believed the financial statements. So here you have all these corporations who have been fighting to keep Sarbanes-Oxley from becoming a law. All of a sudden, they started saying, "Oh, make this a law. You got to make this a law because, unless you do something, no one's going to believe our financial statements." So this became a law, and it became a law because of the fraud of these companies, and it was to restore confidence. In the financial statements. Okay, so that's what the Sarbanes-Oxley Act came from. I mean, we'll talk about it. It's a very extensive act. And it's very interesting act the way it came about and what it actually does. But Sarbanes-Oxley, and there's still some people that want to get this repealed and say, "Oh, we don't need it anymore." And every now and then, though, there's reminders that we do. So, okay, corporate governance. This is something that they're big on at the ACCT433, and you'll see a lot of questions about corporate governance on the CPA exam. And generally the two things they look at are the board of directors and audit committees. And the board of directors, virtually every corporation should have. So if it's a corporation, whether they're issuers or non-issuers, they should have somebody on there. The board of directors, and these are people who they could be inside directors or outside directors, but they're people who actually run the company. These are the people who make the final decisions. These are the people who you are in contact with if you're an auditor. So auditors are generally brought on board by the board of directors. If it's a publicly traded company, they must have an audit committee. If they're not publicly traded, they can't have an audit committee, but it's required for issuers. So if you're publicly traded, you must have an audit committee. It's made up of outside directors and it must have at least one financial statement expert. So they must have at least one financial statement expert on it. So this, if it's an audit committee, if it's there are issuers, they must be outside directors, and they must have at least one financial statement expert. So audit committees, outside direct for publicly traded companies, for issuers, they have to have outside directors. They can't have inside directors on it. Inside directors also work for the company. And they must have at least one financial expert. The financial expert does not have to be a CPA. It has to be somebody who's familiar with making financial statements. And I know that might sound funny, but a lot of times on these board of directors, a lot of times these people are not financial people. The people come from other walks of life, which there's nothing wrong with, but if you're going to be on the audit committee, if you're going to oversee audits, somebody should be familiar with the financial statements, how they're put together, how they're issued, and all that kind of stuff. Okay. This is the last page? No, it's not. This is kind of the AICPA's new push. That is for processing. I should say processing. They're focusing on the processes of doing things rather than simply on the accounts. And you might wonder, well, why are they doing this? Why are they so interested on the process? For instance, the financing process is generally obtaining money. It could be short-term or long-term. Short-term is for the operations. Long-term is for things like capital budgeting and that. You say, well, why don't they look at the process? Why don't they just look at the accounts? If they got financing to make a new assembly plant, okay, well, whatever the account is that those go into, the assembly plant and the financing, why don't you? Well, here's what they're kind of leaning towards, and that is, they say, look, these things don't happen, these accounts don't happen in a vacuum. They all happen for a reason, and they all go through a process. And if you're auditing, those processes for many of these things are automated. They're computerized. And so they say, okay, look, don't just look at the account, look at how they're actually processed and put into those accounts. That we're going to focus on the process. Not that we're not going to focus on the accounts, that we're going to make sure the accounts are not materially misstated. But that the auditing should focus on the process, and the process will lead to better audits. And so that's kind of their push. Probably within the last couple of years, they've had that push. And that's why there are things like Jason was talking about earlier, last week, that they had things like the SOC reports, which are the statements on control, that they're actually doing audits of controls for service providers. Things like sometimes banking, payroll, internet, all these things that these companies will have. They've made these statements, and because they're actually looking at the processes of those rather than simply the accounts. So this is kind of a part of a whole push towards those looking at the process, the cycles, rather than simply the accounts. And it's fairly new, which means if you're taking the CPA exam, it's virtually 100% that you're going to see something on it. They always test new stuff. They give you 6 months nowadays, and then they start testing it, and this has been out for a little bit. So they are going to talk about the different processes and how those go about. These are probably you can probably figure these out without even doing anything with them. But financing for short term, for operations, long term, for capital budgeting, which is buying big stuff. Purchasing process, purchasing goods. Purchasing, it could be anything. Property, plant, equipment, intangibles, etc. The goods cycle is obviously one that is very important to a lot of companies. Human resources, so it's human resource stuff. Inventory management process. This is basically the keeping track of the inventory. For many companies, the inventory is most important. So inventory, logistics, I guess. And how you move inventory out, the process of it, how you assign the cost to it, all that kind of stuff. So it's sort of like here, purchasing, this is getting the inventory in. This is once it's already in, what do you do? How do you account for the cost of it and when it's sold and all that kind of stuff? And revenue is just what it is. When something is either a service or a good is sold, how do you account for that? What is the process of it being sold? How do you know that it's sold and all that kind of stuff? Wait a minute, I got one more page here. Okay. You can look through these, and it isn't that these do away with doing the accounts. You still have to go through each of the accounts. However, the process is also an important part of it, and that you must get an understanding of the process. Okay. Last one on here, last page. And these are some of these are what they call in the past, they call them the general standards. I don't think they call them the general standards anymore, but these are I'm sorry. Something on myself. The professional standards that we have these are for all the auditors of what you must be if you're an auditor. Competence and capabilities. You must be technically trained. In other words, your education. And proficient in auditing. So technically trained, which is what you're doing now, you're getting technically trained. And proficient just means that you know what you're doing enough, that you know it to be somewhat efficient and know exactly what is required of it. So, and by the way, if you don't feel you're technically trained for a certain type of audit, you shouldn't do it. Right? So it's sort of like this: if it's okay to take an audit if you're not familiar with it. It's okay to take an audit if you're not familiar with it, as long as you are able to get familiar with it. All right. So you must be able to. Now, if you don't think you can get familiar enough to take the audit, you shouldn't do it. All right. So, it isn't that you have to be necessarily technically trained for every audit you take, but you have to be able to get the required, and it could be studying, it could be getting getting an expert to come in and to advise you on it. There's any number of ways that you could get the trade. So you don't have to necessarily, if you think about it, it'd be kind of silly. There's no I didn't put a 13 in the handout. Am I talking about something no one else has? It's possible. No. You didn't get them all. Let's see here. Yeah, you can see them treatment folder. Yeah, these are in the textbook too if you want to look those up. Again, this is fairly new. I think it came out a couple years ago. Okay. So does anyone else have the page number 13? If you don't, I'll stop. Probably shouldn't have said that, but oh, it's not in the PDF version, huh? Well, we'll stop on it. So we'll stop with on page on number. We'll get into this later. We'll do this later. So we'll stop here. I think what we'll do is we'll end up going into the let's go ahead and go into the we'll go into the classical sampling. So let's go to classical sampling. It looks like like that. Yeah, let's see, the SOC1 and SOC2 audits, they're not just for cybersecurity. Just so you know, the audits for the SOC1, SOC2, and SOC3. Actually, I can send you guys that. I got a handout on that. Let me see here. And those are types of audits. Maybe this would be a bad time to do those. Yeah, let's do that. I'll send out the thing on the SOC1 and SOC2 and SOC3 though. I'll send it out next week. Those are types of audits. Okay, so let's go ahead and let's look at the sampling. This looks a little dark to me. All right, so sampling is one of the ways that you get enough evidence to make your oh yeah, I don't. Okay, so classical sampling. Now, the idea of any kind of sampling is you take a small group, it could be, whatever it is, and you project it over the large population. So, for instance, the coronavirus, this is an antidote. It's not, what is it? Vaccination for the coronavirus. They will test it on a few people, however many it is, a few relative population, maybe 1,000 or 2 people or whatever it is. And then they'll take that data and project it over the entire population. So they say, okay, it's effective for 95% of the people, whatever. So you take a small amount, project it over the large population. Obviously on Earth, you can't take all 7 billion people and try it out. It's impossible. So you take a small, a relatively small number, few thousand, and you can actually get it usually accurate enough that you can actually get information on it enough that you can project it over the entire population. In auditing, we run into the same problem in that, if let's say you're auditing Walmart, could you do 100% audit of all of Walmart's inventory? It'd be impossible. We don't have enough auditors in the world to do it. All the different stores, all the, the year end, the cutoff, all that kind of stuff. It would be just impossible. But you can take a sample, and if that sample is representative of the population as a whole, you can get fairly accurately, within 1% or 5%, whatever you're going for. You can fairly accurately give a get a handle on their inventory, taking way fewer than the total population. It's just the nature of auditing and sampling that you can do that. You can get very accurate amounts. Get very comfortable with amounts that without going through every single one. And just like for a lot of things, like the inventory for a very large Walmart or Target or one of those, it's impossible to audit those 100%. For instance, things like inventory. So you have to use sampling. And so it's the same thing that when they're testing for vaccines or vaccination stuff, that you can't take everybody on the planet. Okay, so let's go to this. And this is sort of a simplified version of sampling. But the idea of it though is exactly the same. And a lot of times for the CPA exam, they don't go too far into the actual sampling. So this is a lot of stuff I'm going to show you is actually what they'd have. Okay, So this is page 1. Is there anyone that does not have the basic classical sampling thing? Anyone? Okay. All right. So page 1. We have accounts payable with book value of 5 million. And we have total number of accounts payable of 1,000. Okay, so you can get fairly accurate without taking all 1,000. Now, just for our example here, we took a sample size of 10, but you don't have to take all 1,000, and you can get a fairly accurate. If as long as your sample is, pretty much matches what's in the actual. If you take a random sample, that you can get fairly accurate, projection over it. Okay, so coming over here, we have, so these are the book values. So this is what the client has on their books. Okay, so for instance, if your audit client was IBM, this is what they would have on their books, and when you do the audit, this is what you would find. All right, so for each one of these items, this is a sample. So out of that 1,000, they took 10 of them. There are formulas for figuring out the sample size. We're not going to get into. Okay, and they took a sample of 10 accounts. Now you'll see, like for instance, item 1, they're exactly the same, and this is what you'd expect probably from most of them. You go on to number 2, they're a little bit different. Number 3, I've made these a little more exciting than you would normally because you want to find something. But yeah, so if you go through, this would be like what they would find if they pulled those accounts payable. So you're going to find the average of each of those. All right, I think that's, well, I just take 1 0 off, right? Okay, so the client, you took those items from, you went and tested them. That's what you came up with. So the audit average sample is that. That's an arrow, by the way. Okay, so we took our sample, we got the average that we came up with, and we have the average that the client, what they would have as the average for these 10 items. And now comes the problem of projecting it over the big population. So, somehow we want to take these, so here's our sample. Of 10, we want to project it over the entire population, the $5 million. Oops. There's 0 here, I guess. The $5 million and the 1,000 items in the sample. So we're going to take a sample of 10, project it over the entire population. So this is taking this and saying, okay, because of these, this is what we think that this should be. this entire population. So the question is, how do you do it? Well, there's actually 10 ways to do it. Actually, there's only 3. Okay, well, 3 that we're going to count anyways. All right, so on page 2, this is page 2. We are going to use 3 different methods of projecting. So we're going to use the same, these, and we're going to project it over the entire population. I think I'm going to go ahead and transfer these just for mine anyways. And by the way, you guys don't have to use it. If you guys are using, you can use, look, it's a different class. I don't have Tiggy in there. All right, if you want to do this for, you're going to do it on regular notebook paper, that's fine. And just take a picture of it, send it in. You don't have to print this thing out. Or even just copy paste, whatever you have. However you want to write it down. Okay, so I'm going to go ahead and put these up here just so I have them nice and convenient. So this is the average. Okay. And again, I just took those off this page here. With those numbers, just so that I have them nice and convenient over here. Oh, I did that wrong. All right. Ooh, don't use that. Okay, mean per unit means that we take the number of items in the population we multiply that by what we came up with is the average value. And this will be our projected value. Okay. All right, so come back here. We have 1,000 items in our population. We're saying that each one is worth 54.24. And so this will be our projected value. This is what we're projecting the value of the total population to be. So 1,000 times that. So this would be our projected value. Okay, so we have our projected value. Of 5,424,000. And the client has a book value for those of what is a total book value? 5 million. So this will tell us what our misstatement is, our projected misstatement. So our projected misstatement is 424. Now here's the question: is so this is what we're saying that the value of their accounts payable should have been. This is what they have on the books. So is their book value, is it overstated or understated? Anyone?
What was the question?
Are they? Is it understated or overstated or understated?
As understated.
Understated.
Yeah, it's understated. It should have been this. They only have it at 5 million, so this is an understatement. Okay. Let's go now. Let's go to ratio estimation. And ratio estimation is basically you take the average audit value divided by, I should make that line a little better. Divided by average book value times the total book value. And this will be our projected value. So what this one is telling us is basically that larger items will be off by larger amounts and smaller ones will be off by smaller amounts. That there is some kind of relationship between any misstatements, between the size of the account and the misstatement. So that there's a relative value between them that is throughout the entire population. So we take the average audit value of 5424 divided by, so this is the audit, times 5 million. And you'll notice that, you know, this is the book value is basically, this is the total book value, this is the book value of the average of them. So this will show you what the projected difference should be if they were all off by the same ratio, basically. All right. I don't know if there's 240 or 240. I don't know if it's running up or down. My calculator doesn't go that far. I'll say 241. All right, so we just take the ratio of it. So we're projecting it over the entire population, and we're saying that there's a ratio of what they're off by, and that it, that's throughout the population. So that'd be the projected value. Okay, so that is our projected misstatement. And this is what you'd look at to see if it was material. How big does it be to be material? And it varies in the company, obviously. So this is another way of projecting it. And again, this one says that they're off by the same amounts. Just scratch it, the same ratio throughout. Okay, and the last one here. Difference estimation. What this one is that there is a difference between the audit value and the book value, and that usually it's the same amount that it's off by, regardless of how big the item is. All right, so the formula kind of looks like this. Oops. Audit value minus times the population number of items in population. And this gives us this is different than the other ones. This will give us our projected misstatement. In other words, just saying, okay, these are all misstated by a certain amount. So everyone is going to be misstated by the same amount. So this would be 54, 24. I'm just going to do this one first. So 54, 24 minus what is it? Okay, so this is 314. There is 1,000 items in our population. So this is our projected misstatement. So notice that this one's a little bit different in that it does the projected misstatement, what you get from this. And it's saying that, look, everything is off by 314. Regardless of how big the item is, which, regardless of if it's a $2,800 item or if it's an $8,000 item, they're all off by 314. And so the question becomes, well, what should the projected value be? Well, are you going to add this or subtract this to the 5 million book value? Well, our audit value is higher, so this should be added too. It should make this higher by $314. This is going to be an understatement. So this one's a little bit different, and it says you first find a misstatement. All these are misstated by 314. This is the amount of okay, now you'll notice something as we go through here, and that is that these can come up with different numbers. And so it really depends on what method you use as far as which one, what your projected misstatement will be. And also because this is statistics, it kind of looks like this. It'll look like, for instance, this first one says it should be 5 million. This is the projected value. So truthfully, there would be some kind of a, bell curve, that you get some kind of confidence level of where you're at on here, and how sure do you want to be of your number that it, if it's misstated or not. So there is because it's a sampling, we're not going to do this for today, but there is that idea though that this is a sample. So there is going to be the possibility that our sample does not represent the population as a whole. And so the question is, if you have this sample, what are the odds of it being in other places? Okay, let's go ahead and take a break. Maybe we'll come back, we'll do the next one, just to make sure we got it. So let's go ahead and take a break. What time is it? 7:17. Now we'll be back at 7:18 now. How about be back at 7:25? We're not going to get to the chapter 5. We'll do that next week. Okay, so I'll right here say be back. Oops. And we'll do another one of these. And I'll go ahead and put we'll do it together. I'll show you I'll put in a drop for the chapter 1 and 2 handout. And I don't think I'm going to, I might put a thing or two on the first test from that, but I think I'm going to do it as a separate thing. Well, we come back, we'll go over it. Okay. Okay. Well, you guys may have already done this when I came back here. Okay, average audit value is 1,200 divided by 5. 1,100 divided by 5 equals, we got 220. Yeah, could be my calculator. Yeah. Okay. So mean per unit says that we have our audit value, 240 times our total items. All right, particular misstatement was 100,000. And this was an overstatement, right? Because we got a projected value of 2,400,000. They have up here 2,500,000. So the difference is 100,000, but we're saying that there's only be 2,400,000. So this is actually an overstatement. All right, ratio estimation. Oops. That's a 7, by the way. All right, so that's the projected value. Okay, subtract out the book value. The total book value. And this one would be an understatement. Because on this one, it's to be 2,727,000, where they have 2,500,000. So, you know, depending on the method, you can run into this. Okay, difference estimation. So we're saying that every single one is misstated by 20. $20. So we'll take $20. Say everything is misstated by $20. The entire population has 10,000 items. So this is 200,000, and notice that the book is higher than, scratch that, the audit is higher than the book. So we think that this should be higher, so this would be understated. So the projected amount would be yeah, so you can have this, this just because the methods are a little bit different. You can have, you know, it is possible to have it, especially for the mean per unit, because unlike these two methods take into account the book value. This one ignores the book value. You don't have to have the book value for that one. This is what we came up with. This is how many items there are, and so you project it out. So again, using the same data, but this is how you project it over the you know, the entire population, and it can make a difference. If you use this method, it's understated. Excuse me, it's overstated. If you use this method, it's understated.